What makes this one quite unique is that it's IRR, it's after-tax IRR of 29% and payback of 1.9 years, and capital intensity of approximately 1.7 NPV to CapEx is absolutely extraordinary.
All right, welcome back inside our proactive newsroom. And joining me now is Sam Lee. He is the CEO of North Isle Copper and Gold. And Sam, it's good to see you. How are you?
Great to see you, Steve. Thanks very much. Yeah, no, great to be here. We're very busy, and thanks for having me on.
Yeah, I know you've been busy because you just put out some very significant news, and we'll talk about that in just a second. But for those maybe not familiar with North Isle, tell me a bit about the company and a bit about yourself.
Sure. So North Isle, we've got one of the highest return, lowest capital intensive copper gold projects on the planet. We're based right here in BC. Our project is on the North Island, right adjacent to the historical Island Copper Mine. I joined the company about 5 years ago. I'm a metallurgist by training, but spent the last 20 years prior to those 2020 at CIBC. I ran CIBC's global mining practice, most recently out of Vancouver. I couldn't resist with this proposition. I partnered up with our chairman, Dale Corman, who's a mining Hall of Famer, in 2020 to lead this company.
Yeah, now, as I mentioned, you had significant news out of that is a positive PEA put out for that North Island project. So very exciting news. What sort of jumps out at you when you saw the numbers of this PEA?
Yeah, so just to give a bit of a backdrop, the numbers on the PEA are quite extraordinary because it is a $2 billion base case NPV after-tax project. And there are a few of them out there. So, granted, I think people should take caution. Not all $2 billion projects are built alike. What makes this one, and I can show you or compare to other copper projects, what makes this one quite unique is that it's IRR, it's after-tax IRR of 29% and payback of 1.9 years, and capital intensity of approximately 1.7 NPV to CapEx is absolutely extraordinary, right? Because with these longer copper gold porphyry projects, you tend to get higher capital intensity. The problem with copper projects, at least as it relates to single asset junior companies, is that these are very capital intensive projects. And so for the most part, that's why you don't see a lot of companies or even investors endeavoring to get into it because of that capital intensity. So what we have here is a $2 billion project, NPV after tax, with a 29% IRR, which again, for a 29-year life of mine is an extraordinary number, with a very, very low capital intensity. The second part of it is, people always thought of us in the past as a big copper porphyry, which we are. But this PEA has also identified that in phase one, that this is actually a gold project. It's about 70% by revenue gold. And so we produce about 200,000 ounces of gold, about 50 million pounds of copper in that phase one. And then approximately, it's almost a 50-50 copper gold distribution in phase two. So if you were to actually use a reasonable discount rate for gold projects, we think that 5% is reasonable. We use 7% for our base case. But if you use a 5% NPV, at spot prices, this then jumps to a $4.7 billion after-tax NPV project, which is wild. So the leverage to gold and copper is extraordinary here. And if you can see, this project really takes the current environment and really maximizes this condition where you have people that, I think everybody believes that copper fundamentals is there, long-term fundamentals. But we don't see that level of conviction today in today's market, where you see copper spot prices effectively trading at long-term analyst consensus prices. But with gold, you do see it today. It is a commodity that can bridge our project today through to the long-term 20, 30, 40-year copper environment. And so
Yeah.
that's why we do strongly believe that we have now unlocked our copper value through gold.
Sam, in the news release, it's really interesting because you talk a lot about the fact that because you're phasing it in after phase one, you in essence will be funding phase two and beyond with phase one. I mean, it sounds like that's the key to all of this moving forward is, there's a lot of people looking for money these days in certain areas, but being able to get phase one done and then be able to fund the rest of the phases by yourselves is a huge bonus, I would think, for a project like this.
That's right, Steve. And there's a very direct proxy out there, which is Artemis's Blackwater. Right back in 2020, they started with a very large capital-intensive gold project in British Columbia. They broke it up into phases. They funded the first phase. They've now effectively commissioned and about to pour first ounce of gold. And then they're effectively accelerating the next phases through the internal cash flows of phase one. So that is exactly the model that we wanted to progress, and we needed good exploration success in order to do that, to find that higher margin phase one, which we did over the last 2 years at Northwest Expo. And so from our perspective, after 1.9 years, the entire initial CapEx gets paid off after 1.9 years. Beyond that, this essentially cash flows about $300 million a year. And so never in the 29-year life beyond that 1.9 years does the cumulative free cash flow fall below zero before past that point. So 1.9 years payback, and then start funding phase two in year 4 and 5.
Yeah. Let's talk about the next stages here, because obviously putting the PEA out is a huge accomplishment, but that doesn't mean you're not continuing the workload. I know you've got a pretty good treasury, and you plan on using some of that this year in more exploration. Is that right, Sam?
That's right. So, like, just to put it into context, the PEA really does show that phase one, which we call the Northern Corridor, has robust economics. It's about 70% margins versus 50% margins in phase two. So that's where we're spending 100% of our $7 million drilling budget this year. So if we could find more of that higher grade, higher margin, higher NSR value per ton rock, which we now know exists in that Northern Corridor, that will be immensely accretive. The other important thing for people to note is that the discovery we had last year at West Goodspeed, that just kind of is on the southeastern part of that Northern Corridor, is not in the resources. It's not in the PEA because we had just discovered it, but we had drilled 16 holes across approximately 1 kilometer strike. About 85% of our drilling this year is going to be used to not only develop a resource or an initial resource across the 1 kilometer strike, but also to extend it laterally in the northwest direction. The last piece of exploration is this chasing this high grade causative intrusion at Northwest Expo on the northern part of the Northern Corridor, which is where we saw the high grade gold zones in the pit shell of about 2+ grams per ton across thick meters at surface. So we believe that causative intrusion is coming towards the southeast, and that's where we're going to be spending the last 15% of our drilling. Obviously, if we see strong success in intercepting that high grade zone at Northwest Expo, we will be shifting a lot of our drilling budget toward Northwest Expo, as that at this point is the highest yield and margin rock that we have on the property.
Absolutely. Makes a lot of sense. Well, I know it's going to be a very busy one for 2025. It already is, Sam, and congratulations on this really positive PEA. Very exciting news, and we look forward to following your story this year, okay?
Thanks very much, Steve. Appreciate it.
All right, good stuff. Sam Lee, he's the CEO of North Isle Copper and Gold.